Hello traders, welcome back to the Forex gig. In today's video we're going to be talking about the home pigeon pattern, a candlestick formation that signals potential market reversal. You will learn how to trade this pattern consisting of two specific bearish candles and use it to find strategic entry points in your trades. Whether you are trading the forex, the stocks or cryptocurrencies, this pattern works best across all markets. So stay tuned till the end to master the exact rule for trading the homing pigeon pattern. Now what is this pattern all about? What is the home pigeon candlestick pattern all about? It is actually formed during a downtrend and consists of two consecutive bearish candle. The first candle is large in size, while the second candle is smaller and completely within the body of the first candle. This signals that the selling pressure begins to weaken. The second candle shows that the bears could not push the price lower than the previous day range, suggesting potential exhaustion in the current downtrend. This is what this pattern is all about, and this is a particular example of this pattern. The pattern signifies lies in its ability to signal a potential trend reversal. Its signal lies in the ability to potentially identify a trend reversal. While both candles are bearish, the specific arrangement suggests that sellers are losing momentum. This is what it means, that sellers are losing momentum and buyers might be prepared to take control over the market. And as we can see, this is a typical example of the pattern. After we see a large bearish candle, we see a small bearish candle that forms after the large bearish candle. Now let's see how we can validate this pattern. To verify this element, we have to first find out that both candles are bearish. The first candle and the second candle are both bearish candle. They are either red or black, whatever color you are using for your charts. The second candle open must be lower than the first candle open, signifying that it is a double bearish candle. The second candle close must be higher than the first candle close. Where the first candle close, the second candle close must be higher than the first candle close. The second candle must be shorter than the first candle. As you can see, the second candle is short in comparison to the first candle from this diagram over here. So you have to pay particular attention to the location of this pattern. The most reliable signal occurs near support areas after extended down moves, after an extended downtrend where price have fallen for at least 10 candles without significantly pulling back. And as we can see, price has been falling for a while without pulling back. This is why this validates the pattern. And as we can see, the pattern happened to be at a strong support area. Even if it broke the support, but we can see that price is breaking back above the support region. This was signals and confirms this trade setup. The pattern becomes invalid if any of these conditions are not met. Now let's see the types of home pigeon pattern. While many traders view the home pigeon as a single pattern, it actually manifests in two distinct variations, each offering unique trading opportunities in different market conditions. Now the first pattern we're talking about, the first type of the home pigeon pattern is the the bullish homing pigeon pattern, which forms during a downtrend and signals potential reversal to the upside. And this is a clear example. It is formed during a downtrend. You can see the market is making series of lower lows, lower highs, lower lows, lower highs, lower low, and this signals a potential reversal to the upside. While the second pattern is the bearish homing pigeon, though less common, appears during a strong downtrend, and this signal often signifies a continuation. The second pattern signifies a continuation, while the first pattern signifies a reversal. In this case, the pattern suggests that sellers are regrouping before pushing price lower. This variation requires extra caution. It requires extra caution and confirmation before trading, and this is a typical example of the pattern. You can see it here. Price is still in the downside. It just signified a pause to retrace back before continuing down in the direction, while the main pattern signifies a typical reversal. The bearish homing pigeon pattern signifies a pause in price to form its retracement. As you can see, this is another example in the chart to signify its retracement and the continuation in the trend of the market. Now, the difference between these variations lies in their location within the trend and subsequent price action. The bullish pattern typically occurs near a support level or after an extended downtrend, while the bearish pattern appears during a strong downtrend but often after a small pullback. This is when it occurs in price. This is when we expect it to occur in price. After a small pullback, we expect the pattern to occur. Regardless of this type, always wait for the confirmation before you enter your trade. Regardless of the type of pattern that shows, you have to always wait for a confirmation. We will explore exactly how to identify this pattern with precision. Let's see how we can add this to our trading strategy. Trading the homing pigeon pattern requires a structured approach with price entry points, stop losses, and profit targets. So let's break each of them down. Let's break each components down to an effective trading strategy. For the entry, we have to wait for the candle to follow the candle following the homing pigeon pattern to close after the high of the first candle. We have to wait for the next pattern after the high of the first candle. Once it closes after the high is when you would want to enter. We would enter exactly at the area. This is the high of the first candle. Once the price has closed above the high of the first candle, we would want to enter the trade. Remember, the stop loss placement is very crucial for risk management. Always place your stop loss just below the low of the second candle. You place it just below the low of the second candle, as we can see from the chart, below the low of the second candle, because this level provides a clear invalidation point for the pattern when keeping your risks defined. Our profit target usually use a minimum of 1:2 to target your profits. This means if you are using a stop loss of 20 pips away, our profit target should be at least 40 pips to be considered. We have to consider using multiple time frames or multiple take profit targets. We can actually use our first profit target to be 1:2. We take out a portion of our trade, and when you consider your second profit target should be 1:3, where you will take another portion of your trade. You can also use the previous swing lows and highs as a as an area to take your final take profit target. This is where you can take profit finally. These are the ways that we can use to manage our trade. Let's not forget that position sizing should be based on your risk tolerance. Never risk more than 1 to 2% of your trading account on a single trade. Always calculate your position size based on the distance to your stop loss area. Always calculate your position size. Remember, not every pattern will result in a profitable trade. The key is consistency in applying these rules across all your trades. So I would advise, before you start taking your trades, you have to practice this strategy on a demo account to get acquainted with the strategy before applying it to the real life market. Alright traders, the home pigeon pattern provides a clear trading opportunity when you follow the rules. Remember that you have to wait for the pattern confirmation, maintain strict stop loss, and always trade with proper position sizing. We have come to the end of this video. Hit the like button and subscribe to the channel. Turn on the notification bell to stay updated to more trading strategies and videos. Thank you for tuning in, and until next time, happy trading.